Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Ed Lopez, Head of Product Management at VanEck. We're here to discuss the Fallen Angel High Yield Bond ETF and what type of market cycles it performs well in. Ed, it's great to see you as always. Welcome back to TradeTalks.
Yes, thank you very much.
So what are Fallen Angels? I think it's a very interesting name for an ETF. How have they performed versus the wider high yield market?
Yeah, it is an interesting name. It's a very catchy name, but a lot of people don't really understand what it means in high yield. It was kind of the original high yield when high yield trading started in the 80s. But basically what that was is these bonds were bonds that were originally issued as investment grade bonds. And for whatever reason, maybe they took on too much leverage, or the economy in their markets turned on them, they were subsequently downgraded to high yield. That would be double B or lower. Now these are name brands, typically large companies with resources that just basically have fallen on hard times. But they have the resources to get themselves back. And one might ask, why would I want something that has been downgraded? And the reason is because there's an embedded value proposition there. There's a structural opportunity for investors to buy these bonds at a good value, at a discount even at times. And it's proven out over the long term. They've outperformed the broad high yield market. They've outperformed in a variety of market cycles.
Are there market cycles where Fallen Angels perform better or worse?
It's kind of an all-weather type strategy. There are times where it does a little worse than high yield, but generally it can perform well in a rising rate environment where the economy is strong and rates are going up modestly. That's good for the constituents. Or it can do well in a declining rate environment. That is also good for the constituents. It does well in an environment like we're in right now, where spreads are tight. We're like in the 200s in terms of high yield spreads. But those spreads can remain tight for a while, and given where yields are today, at near between 6 and 7%, you have a nice cushion to sit and capture some yield. And even if the market takes a little bit of a stumble in that area, you have that cushion to help balance it.
So you would consider Fallen Angel bonds now, even if interest rates were to move lower, I mean, we don't have to fix income in that kind of environment, or it won't impact it that much?
On a relative basis, relative to high yield or broad high yield market. If you're a high yield investor, I think this should be something that should be a core of your portfolio. Because they've been downgraded from investment grade, they also tend to be higher quality. Something like 82 to 85% of the Fallen Angel index is double B versus only 49% for the broad high yield market. And so even if spreads widen out in a kind of a credit event, you might still see Fallen Angels do better than the broad-based high yield market because they have a higher quality stance.
Ed, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.